General risk disclosure. Trading financial instruments, including forex, futures, equities, commodities, and cryptocurrencies, involves significant risk of loss. Trading is not suitable for all investors, as it may result in the loss of your entire investment. Leverage, volatility, and liquidity risks are inherent in these markets. Before engaging in trading, carefully consider your financial situation, experience level, and risk tolerance. You should only invest money you can afford to lose. Forex and futures disclaimer. Trading in the forex and futures markets is highly speculative and carries a substantial risk of loss. The leverage nature of these instruments amplifies gains and losses, potentially leading to substantial financial exposure. This content complies with CFTC Rule 4.41. CFTC Rule 4.41 disclaimer. Hypothetical or simulated performance results have certain inherent limitations. Unlike an actual performance record, simulated results do not represent actual trading. Also, since the trades have not been executed, the results may have under or overcompensated for the impact, if any, of certain market factors, such as lack of liquidity. Simulated trading programs are also subject to the fact that they are designed with the benefit of hindsight. No representation is being made that any account will or is likely to achieve profits or losses similar to those shown. Equities and commodities disclaimer. Equity and commodity trading involves risks associated with market volatility, company-specific factors, and geopolitical events. While stocks and commodities may have a lower leverage factor compared to forex or futures, they can still result in substantial financial losses. Cryptocurrency disclaimer. Cryptocurrencies are speculative and highly volatile instruments. Trading cryptocurrencies involves additional risks, including regulatory uncertainties, security vulnerabilities, and lack of liquidity. Cryptocurrencies are not regulated by most governments or central banks, and their value may be affected by external factors such as news events and market sentiment. Regulatory references. In the United States, this content adheres to the regulatory standards of the Commodity Futures Trading Commission, National Futures Association, and Securities and Exchange Commission. In the European Union, trading practices comply with the European Securities and Markets Authority standards. Global compliance, content aligns with internationally accepted guidelines, but laws vary by jurisdiction. Consult with a licensed professional in your area. Past performance disclaimer. Past performance is not indicative of future results. Any historical results or performance shown in this content are for informational purposes only and do not guarantee future performance. Educational content disclaimer. The information provided in this video is for educational and informational purposes only. It is not intended as investment advice, nor should it be construed as a recommendation to buy, sell, or hold any financial instrument. Always consult with a licensed financial advisor or regulatory authority in your jurisdiction before engaging in trading activities.
All right, let me knock this out. I didn't do Friday, and I'm okay with it, but I did the week. So this week, boom, boom, boom. I don't need the whole 2025. Look at this. So let me zoom in. Oh, snap. I think I zoomed in on the wrong thing. Hold on. Did I zoom in on this? Okay. I think I zoomed in on the wrong screen. Boom. All right, so look. Bullish sentiment went down about 6%. Bearish sentiment went up. And cash on the side went down. So these are smart people. They laid in the cut, waited for Trump's tariffs, and bought puts. Genius. Everybody knew it was coming. The VIX is about even right now. So where I believe it was commercials had most of the open interest. Net long, net change, commercial, net long, net change. Non-reportables added more shorts than long positions, shifting their net exposure slightly short. Significant increase in spreads, more complex strategies for non-commercials. Yeah, so they're hedging. Non-commercials are short for the most part. Non-reportables, which are usually the more nimble guys, are more long. Percent of open interest for the commercials is the highest, so the commercials are in control. And the commercials are slightly more long. Non-reportables are slightly more long. And the non-commercials are probably wrong with slightly more shorts. But they're still hedging for the most part as well. News is CPI week. Thursday is going to be the pivot. CPI always sets the tone. Macro is looking bearish right now. Fed watch. People are betting on cuts in May, but CME's not saying so. But June, CME is saying so. 94%. It was 100% when I did it on Thursday. It went down to 94. Let's look at earnings. Banks are coming. That means tech is right after. Well, not right after, but anytime you see banks, it lets you know it's earnings season's coming. Earnings season, I think last earnings season was a lot of drops, and they was beating earnings, so we'll see. Let's do this right here. Dollar on the daily. We're accumulating in this dollar. I don't know why it makes sense for it to push up and then go back down. That's textbook. But when we got a candle inside a candle, I'm thinking sideways, CPI, and then, the real direction. And for me, I would want to see it run the lows first, just so all the people that want to sell dollar can get trapped before it goes to this imbalance. That's kind of like what I'm leaning on there. Dollar, it's a lot of commercials are short, but they're hedging the non-commercials long. And the open interest is in the non-commercials favor. So they're in control of this. Non-reportables, they look short. Non-commercials look long. So we could have just a push up based on this, depending on how strong these positions are, because this is just number of contracts. They could be little contracts. NASDAQ on the month, super bearish. We broke this range. We're back in this old range. 15,863 monthly liquidity target. It looks far here, but when I went down to the lower time frames, it really wasn't that far. But order flow is definitely bearish. It looks like we got a 3 drives on the monthly. So if this month's finished bearish, then next month's will be definitely super good for a retracement. I would rather see it consolidate and then maybe a reversal. Weekly, super bearish. This is December 23rd low, or this is 2023. We cleared everything from 2024. Like all 4 quarters of 2024 has been passed through. So we're in 2023 price range. December 23rd low is 17,174. That's a key level because it's an old monthly low. I tagged this and put it here. Daily chart, look at Friday. We can chop inside of Friday. So Friday high low is the only thing I'm really looking at for the daily. On the 4-hour, we got us a nice retracement fair value gap here. I could see price retracing there and then selling off. That'll be ideal, one shot, one kill for me. And on the H1, we're closing below down candles. It's too bearish for me to sell here. I will wait, try to sell a retracement. I'm not going to go in chasing this sale. And that's what I'm looking for to start the week. Y'all keep it cool. Peace.